The amateur era of college sports died quietly in a boardroom, replaced by an asset class Wall Street can't resist. For a century, the economic model relied on wealthy donors and tax write-offs. That era is over. We are watching a hostile takeover of the $20 billion college sports ecosystem by private equity. The point of no return occurred in December 2025. The University of Utah signed a landmark $500 million deal with Otro Capital, crossing a line that had held firm for 100 years. They didn't just take a loan, they formed Utah Brands and Entertainment LLC, a commercial entity designed to extract profit from amateur athletics. This isn't about funding a scoreboard, it is about securitizing future media rights and student earning power. It turns public universities into financial vehicles for institutional investors. To understand why schools are selling their future, look at the bill that just came due. The financial catalyst for this takeover is the House vs. NCAA settlement. When this deal was approved in June 2025, it triggered a liquidity crisis that shattered the economic model of college athletics. The settlement requires schools to pay $2.8 billion in back damages to former athletes. However, the true liability is the new forward-looking expense, a mandatory annual revenue sharing cap of approximately $20.5 million per school. This figure represents 22% of the average athletic revenue for power conference schools, effectively turning student athletes into salaried employees. Let's break down the math problem this creates. Most athletic departments, even in the Power 4, are structured to break even. They reinvest every dollar of revenue into facilities and salaries. When you take a break-even business and add a $20.5 million fixed cost, you create an immediate structural deficit. For most top-tier programs, we are analyzing a shortfall of $10 million to $15 million annually. This is not a temporary cash flow issue, it is a permanent solvency crisis. This exposes a massive power vacuum. In the past, athletic directors would rely on donors to plug budget holes. That option is gone. Donors are suffering from fatigue after years of funding NIL collectives and capital projects. They cannot cover a perpetual operational deficit of this magnitude. Furthermore, the NCAA Central Authority has completely eroded, leaving individual schools exposed to raw market forces without a safety net. The crisis is compounded by widening inequality. The media revenue gap between the SEC and Big Ten compared to everyone else has grown nearly 600% since 2002. Schools outside the Power 2 are trying to pay the same $20.5 million labor cost to compete for talent, but they are doing it with a fraction of the guaranteed revenue. This creates a distressed asset class, universities with massive brand equity but zero liquidity. With balance sheets bleeding and no viable way to cut costs, Wall Street offered a solution. But as we see with the new deal structures, the terms of that rescue are changing the game entirely. We need to look closely at the specific deal structures that are rewriting the rulebook, because the devil is in the term sheets. The most critical case study is the University of Utah's agreement with Otro Capital from December 2025. This was the first true private equity entry into a public university's athletic department, and the structure they use is the blueprint for the entire industry. Utah didn't just sell a piece of the athletic department directly, because legally they can't sell a public asset that easily. Instead, they created a special purpose vehicle called Utah Brands and Entertainment LLC. This new commercial subsidiary manages the university's media assets, sponsorship rights, and ticket sales. Otro Capital injected up to $500 million into this LLC in exchange for a minority stake in future revenue. The genius of this structure is the separation of powers. Utah retains absolute control over the sports side, hiring coaches, recruiting players, and scheduling games. However, they ceded significant influence over the business side. The investors now have a seat at the table when deciding how to monetize those games. This sets a historic precedent, a public education institution formally sharing profit with private investors. Contrast this successful execution with the friction we saw at Florida State. FSU spent months in negotiations with Sixth Street, a massive investment firm, but the motivation was different. FSU wasn't just looking for operating cash, they were looking for a war chest to buy their way out of the ACC grant of rights agreement. They needed hundreds of millions of dollars immediately to pay the exit fee and join a more lucrative conference like the Big Ten or SEC. The deal stalled not because the money wasn't there, but because of the legal complexity of valuing public assets for a private buyout. FSU illustrates the desperation of Power 4 schools that are trapped in bad media deals and are willing to mortgage their future to escape them. Use this as a lesson. The demand for capital is high, but the regulatory roadblocks for public universities remain a massive friction point. If we zoom out from individual schools, we see the conference-level strategy. The Big Ten explored a massive $2.4 billion partnership with UC Investments. This is a different beast entirely. Here, the conference itself is looking to monetize its media rights and commercial operations at scale. This approach is more efficient for investors because it diversifies risk across multiple schools, but it centralizes power even further away from the campuses. The most sophisticated evolution we are seeing is synthetic NIL. In this model, private equity firms act as super donors. They front the cash required for roster construction, literally paying the salaries for the football and basketball teams in exchange for a structured return on media rights or ticket surcharges. This bypasses the traditional donor fatigue problem. Instead of asking a wealthy alumnus for a donation, the school asks an investment fund for a capital injection, promising a return on investment. These deals solve the immediate cash flow problem created by the House settlement, but the long-term cost involves securitizing the sport itself. You have to understand the core insight of private equity. This is not free money. Institutional investors typically target returns of 20 to 30%. When a university takes $500 million today, they are not getting a grant. They are taking on a liability that will cost them billions over the next 2 decades. This is the securitization trap. Schools are mortgaging their future media rights and NIL revenues to pay for today's roster. If the value of media rights stagnates or drops, which is possible given the cord-cutting trends, schools will still owe those returns to their investors. This creates a scenario where athletic departments could become zombie entities, existing solely to service the debt held by Wall Street firms. There is also a massive conflict of interest regarding how decisions are made. If a PE firm owns a stake in commercial rights, their priority is efficiency and ROI. They do not care about the non-revenue sports that lose money. We are already seeing pressure to cut Olympic sports or turn them into club teams to protect the profit margins of football and basketball. Let's visualize the incentives on the table. University administrators are desperate for immediate solvency to meet the $20.5 million House settlement mandates. They will sign bad long-term deals to survive the current fiscal year. PE funds are chasing undervalued media assets and operational efficiencies. They want to strip mine the inefficiencies of the collegiate model. Broadcasters are pushing for consolidation to maximize ad revenue, which aligns with PE's goal of creating super leagues. Finally, the athletes are getting paid now, which is good, but they are losing long-term leverage. If revenue streams are locked into debt service for 20 years, there is less money available for future collective bargaining. For those of you looking to enter this industry, the sports finance skill set is now essential. The days of the glad-handing athletic director are over. The new power brokers are financial engineers. Aspiring executives need proficiency in financial modeling, deal structuring, and valuation. You need to understand how to value a media rights tier or structure a special purpose vehicle. There are specific roles opening up right now that didn't exist 5 years ago. Look for positions like private equity associate at firms like Sixth Street, Otro Capital, or Redbird. On the school side, look for director of capital strategy or NIL compliance officer roles that specifically manage third-party capital flows. These are the people building the plumbing for the new economy. The future outlook points toward a professionalized model where public universities operate essentially as pro-franchises with tax exemptions. The trend is moving towards super leagues funded by private capital, where the biggest brands break away from the NCAA entirely. The amateur model is gone, and the business model that replaced it is strictly transactional. If you want to survive in this landscape, you need to stop thinking like a fan and start thinking like a shareholder. Wall Street isn't saving college sports. They are acquiring it at a discount while schools are desperate for liquidity. The Utah deal is just the pilot program for a system where student athletes and fans become line items in a private equity portfolio. If you want deep dives on the specific term sheets of these deals and how to position your career for the new sports economy, make sure to subscribe to Revenue Racers right now.